It's a great pleasure to be here. Thanks for including the paper on the program. This is a paper about staking levels in a proof-of-stake blockchain. So I recognize some of you may not be totally familiar with the blockchain technology. So for the purpose of this talk, I really want you to think of a blockchain as a ledger that records cryptocurrency transactions. When these transactions are recorded, you can think of them as being settled. And the main innovation of blockchain is to say, rather than having a centralized intermediary that determines which transactions get settled, at what time, and in which order, instead, what we're going to have is we're going to have agents that are incentivized to compete to win the right to update the next batch or block of transactions to the blockchain. Okay, so the rules of this competition is basically this sort of key innovation I was talking about. And they're generally referred to as consensus protocols. And there's two sort of protocols that we see in use. There's the original consensus protocol, proof of work. This is the Bitcoin protocol. This involves these sort of mining and high energy expenditure that you may have heard of. And more recently, blockchains seem to be sort of migrating to this alternative type of consensus protocol, which is called proof of stake. And that's what we want to study here today. Now, under proof of stake, there's no mining, there's no energy expenditure. Instead, investors are going to stake their cryptocurrency in order to compete for block rewards, which are basically, sort of fixed values of cryptocurrency that they earn. Okay. In this paper, we want to focus on the economics of the proof of stake protocol. And we have one particular question in mind, which is, how does the staking level, which is the market value of staked cryptocurrency, vary with the rewards that incentivize that staking behavior? Okay. Now, before I continue, I should convince you that this sort of staking level that we're studying here is indeed an important object and something that we really want to understand in the blockchain world. And the reason why this is so important is because these staking levels are directly related to the security of the blockchain. So one easy way to think of it is the staking level, meaning the market value of staked cryptocurrency, is proportional to the cost of disrupting the blockchain transaction activity. Okay? When we first started this project, we said, okay, this security and the risk of the transaction activity being disrupted, it's really important for adoption of the blockchain technology. Nowadays, we can also point to an even more important reason why we care about this security, because proof-of-stake blockchains are housing now over 90% of all decentralized finance activity. And there's a lot of money invested in these decentralized finance applications. There's a lot of dollar volume. 24-hour volume is somewhere between $1 and $4 billion. Okay, so if you want basically a well-functioning DeFi ecosystem, you basically need a secure blockchain that ecosystem is built upon, and therefore you need sufficiently high staking levels. Okay, so how does staking work? So here's sort of the simplified version. So proof-of-stake blockchains, they're going to update and maintain the transaction ledger through the staking process. Any investor that holds the proof-of-stake cryptocurrency, let's say Ether for the Ethereum blockchain, they can stake that currency at any time. Once they stake, that currency is going to be held dormant, and then the competition is going to begin. So the protocol at regular intervals of time is going to come along and select a unit of staked cryptocurrency from the set of staked cryptocurrency. It's going to select it uniformly at random. So this is really like a lottery. And the owner of that unit of staked cryptocurrency is going to be allocated the right to add the next batch of transactions or block of transactions to the blockchain in exchange for this block reward, which again is a fixed sort of amount of the underlying cryptocurrency, in this example, Ether. Okay, so staking requires holding your cryptocurrency dormant so that you can earn these block rewards. The block rewards are creating the incentive to stake. Of course, when you invest in the cryptocurrency, you have other options nowadays. You can invest it, for example, in the DeFi opportunity. So you're going to sort of contrast your decision to stake with what you could earn from, let's say, providing liquidity to a decentralized exchange. As I mentioned earlier, the staking level is the market value of all staked cryptocurrency. It's very important for security and the functioning of the underlying blockchain. And because block rewards are creating the incentive to stake, is sort of a natural intuition, which is that if you want to support higher staking levels, you should just increase the block rewards. And what we're here today is basically to demonstrate that when you think deeply about the economics of this problem, this is not actually going to be true. And so block rewards are going to have sort of an inverse U-shaped relationship. Most importantly, they're going to be decreasing, staking levels are going to be decreasing in block rewards when those rewards are sufficiently high. So if you're the Ethereum blockchain and you want to promote higher staking levels, it's going to be crucial for you to understand which side of this curve you're on, because in that case, you may need to actually decrease block rewards in order to increase staking levels and security of the blockchain. So just to give you a preview of the results and how we derive them, we're thinking about a model where we have overlapping generations of agents. And these agents are going to have different trading horizons. We think this is a very practical assumption, but this is a key assumption that's driving the results. So when the agents arrive, they decide whether to invest in the cryptocurrency or take some outside option. And the difference, conditional on investing in the cryptocurrency, in each period of holding, our investors are going to receive a liquidity shock with some fixed probability. Conditional on getting your liquidity shock, you exit the model and you sell your cryptocurrency to the newly arriving agents. Now, the difference between our two investors, we're going to have long horizon investors and short horizon investors. Long horizon investors are going to receive basically a smaller probability of having a liquidity shock in any period than short horizon investors. So on average, they're going to hold the cryptocurrency for a longer period of time than the short horizon investors. Okay. Now, one of the key drivers of our results is the fact that we're going to show that these block rewards are going to create redistribution from the short horizon to the long horizon investors. So if we hold the adoption decisions fixed and we increase the block rewards, this is always going to be a good thing for long horizon investors, and this is always going to be a bad thing for short horizon investors. Okay. Now, the main result, again, is that we have this sort of inverse U-shaped relationship between staking levels and block rewards. And the idea here is once we factor in the optimal adoption decisions and how they vary with the block rewards, what we're going to see is that overall investment in the cryptocurrency is eventually decreasing in those block rewards. And I'm going to try to convey some intuition about this mechanism in the next few slides. Okay, so here's a snapshot of the model, some of the core features. So we have a cryptocurrency that grows at a fixed rate rho. So rho here is going to be sort of synonymous with our block rewards. Any excess cryptocurrency growth in each period, that's going to constitute the block reward. That's going to be shared amongst the agents that compete in the proof of stake competition. Each investor is basically trying to maximize their expected terminal wealth, where the time that you liquidate is going to be random. And your cryptocurrency holdings queue can depend on whether you decide to invest the cryptocurrency in staking or invest it in a competing sort of DeFi protocol to earn some of the fee revenue. So I'll talk in more detail about that on the next slide. So investors are going to decide whether to invest in the cryptocurrency if their payoffs are basically from investing in the cryptocurrency and either staking it or investing in the DeFi protocol are higher than some outside option. And because our agents are basically, aside from their trading horizon, ex-ante identical, we're just going to have some cutoff thresholds for long and short horizon investors that are going to determine their adoption. And these are basically going to be synonymous with long and short horizon investment in the cryptocurrency. Okay, so speaking to how the evolution of your cryptocurrency's holdings occur after you invest. So as I said, we're going to allow the investors to either stake their cryptocurrency or invest it in a DeFi protocol. So as in practice, when you stake, your time T+1 holdings are going to be equal to your time T holdings plus basically a pro rata share of the block rewards. Okay, so if I stake 1/10 of the block rewards over time, I expect to earn about 1/10. If I stake 1/10 of the cryptocurrency, I expect to earn 1/10 of the block rewards over time. Now, for the DeFi protocol, we're going to assume that this protocol generates some fee revenues. And again, as in practice, these fee revenues are shared pro rata among DeFi investors. And there's one important feature that we want to capture for our DeFi fee revenues, which is effectively that if you have less and less investment in the DeFi protocol, then you're going to have less and less fee revenues, right? As Jongsub was alluding to, certain cryptocurrencies that have very low liquidity in decentralized exchanges, they're subject to price manipulations and all sorts of bad behavior. And so that's going to disincentivize anybody from trading with those decentralized exchanges, and that's going to minimize the fee revenue that you can obtain. So in order to capture this feature, we're basically going to take a sort of reduced form approach where we're going to assume that the fee revenues are proportional to the cryptocurrency market cap. You can see this is somewhat empirically true. And if you look at fee revenues and Ether value, for example. So we're going to assume it's proportional to cryptocurrency market cap if there's sufficient investment in the DeFi protocol. Otherwise, the protocol is not going to be able to generate any fee revenues because there's not sufficient investment. Okay, so if you invest in the DeFi option, so you buy the cryptocurrency, you stake it into the DeFi option, now your time T plus holdings are your time T holdings plus your pro rata share of DeFi fee revenues, conditional on the DeFi option being viable and therefore generating positive fees. Okay, so here's basically our first result, which is our equilibrium staking levels are going to be a product of sort of two variables. One is the staking ratio, which is the fraction of newly arriving investors that decide to stake their cryptocurrency as opposed to investing it in the DeFi protocol. And the second is going to be the market value of new investment in the cryptocurrency. Okay, so that's really going to be the two drivers of our equilibrium staking levels. And it's important to note that this staking ratio is always going to be increasing in the block rewards, right? The idea here is that in equilibrium, the staking ratio is going to be chosen to equate the return from staking with the return from DeFi investment. And so when you increase block rewards, you're going to increase the return to staking, and you're always going to incentivize more people to choose to stake. So this is sort of where that natural intuition, where higher block rewards lead to higher staking levels, could come from, because it is true that the staking ratio will always increase in block rewards. But what we're here today to tell you is that even though the ratio is increasing, the equilibrium staking levels can be decreasing in block rewards. Now, in order to make that last point, basically, in order for me to convince you that staking levels are decreasing in block rewards at some point, I need to show you that new investment is going to be decreasing in block rewards when they are sufficiently high. And then I can talk about the comparative effects of the change in these two variables once I've convinced you that investment is eventually decreasing in block rewards. Okay, so why is this the case? Why is investment decreasing in block rewards when they're sufficiently high? Well, as I mentioned earlier, block rewards create redistribution from long horizon to short horizon investors. And this is, so the important thing to recognize here is that these block rewards are paid as newly minted cryptocurrency. So this is not like some increased production. This is really an inflationary transfer. Every time a block reward is paid, it's paid from everybody holding the cryptocurrency to the validator that won the proof of stake contest and won those block rewards. Okay? So because of this sort of redistributionary channel, or this sort of inflationary tax, right, higher block rewards are always going to be bad things for short horizon investors, right? Staking is a zero-sum game, right? Whenever somebody earns block rewards, others are paying for it. And so because of the fact long horizon investors are staking longer than short horizon investors, they're going to earn more of those staking rewards. Everybody's going to pay the same amount of inflation when they first purchase the cryptocurrency. And so it's long horizon investors are earning more, short horizon investors have to earn less. Okay, and this is how we interpret this sort of redistributionary effect of block rewards. Okay, so once we sort of factor this in, what we're going to see is that, okay, short horizon investors really dislike block rewards. When you increase block rewards, you're going to get less short horizon investment. But when you have less short horizon investment, you're going to get less redistribution to long horizon investors. They're going to dislike this lower redistribution, and that's eventually going to lower the long horizon investment. And I think we have a very simple intuition to explain exactly this mechanism of why eventually short horizon investors are decreasing their investment in the cryptocurrency. And the idea is to think of it as when we increase block rewards, we're increasing the transfer rate from short to long horizon investors. But the overall transfer received by the long horizon investors depends not only on the rate, but it depends on the base of the transfer. And in this context, the base of the transfer is the total amount of short horizon investment. When short horizon investment falls sufficiently, this means that even though you're increasing the transfer rate, the overall transfer will eventually decline, and therefore long horizon investor payoffs and therefore investment are also going to decline for sufficiently high block rewards. And there's already a well-known analogy that sort of captures this effect in the context of taxation, which is this sort of Laffer curve, right? The idea being as you increase tax rates, initially you expect to increase tax revenues, but once the agents internalize those tax rates on their labor decisions, they provide less labor, and even though you increase the tax rates, eventually your tax revenues will fall. Okay, so in this context, the long horizon investors are basically trying to collect these tax revenues from the short horizon investors, but if they tax them too much, the short horizon investors will simply work less, and then the overall rate of the overall transfer will decline. Okay, so here's sort of a picture of the main results, summarizing a little bit of what I've said so far. So on the x-axis, I have the block rewards or the cryptocurrency growth rate. And then here you can see I'm plotting the short horizon investor payoffs, which are strictly decreasing in block rewards. These payoffs are also basically one-to-one with the short horizon investment. So that also means short horizon investment decreasing. Here you have long horizon payoffs. They can initially start off increasing, but eventually, as through the mechanism I just explained, they will be decreasing. And as you can see, I have staking levels in the black. This is going to be this inverse U-shaped relationship that our main result is capturing. Okay, so finally, the last thing is I've convinced you that investment is decreasing, but I did tell you that staking ratios are always increasing. So given that staking levels are the product of these two, we basically have two competing effects that determine whether staking levels are increasing or decreasing in block rewards. Okay, so basically the first effect, the increase in the staking ratio, is going to dominate when block rewards are low. And the second effect, the decrease in investment, is going to dominate when block rewards are high. To give you some idea why this is the case, for low block rewards, the effect of increased staking ratios dominates because when you have low rewards, you're going to have very low staking, you're going to have high DeFi investment, and most importantly, you're going to have high short horizon adoption because the short horizon investors are not being taxed that much when you have sufficiently low block rewards. This means that when you increase the rewards, you're going to generate a very strong incentive for agents to switch from DeFi to staking. That's going to lead to a large increase in the staking ratio that's going to offset any change in the underlying investment in the cryptocurrency. Okay. In contrast, when you have high block rewards, now you're going to have a high staking ratio, right? And this means you're going to have less and less DeFi investment. So the DeFi option is going to become less viable. It's going to generate lower fee returns. And more importantly, you're also going to have low short horizon adoption. And that means when I increase the block reward sufficiently, right, the change in the staking ratio is going to be small. There's going to be weak incentives to switch from DeFi to staking, especially because there's very few short horizon investors. And so the investment effect is going to dominate the sort of staking ratio effect. Okay, so just to quickly conclude, in this paper, we're studying proof of stake security. Right, this security depends crucially upon staked investment, the market value of staked cryptocurrency. And what we're showing is that staking levels and therefore security are not monotonically increasing in rewards. Instead, eventually they will be decreasing. And this is going to be important for basically the design of these block rewards at any proof of stake blockchain. Just to recap, the main mechanism is the idea that these block rewards are transferring wealth from short horizon investors to long horizon investors via the inflationary effect that they generate. Higher rewards is going to increase this inflationary tax on the short horizon investors, which is going to lower short horizon investment. Once that short horizon investment is sufficiently low, it's also going to lower the long horizon investment, right? And this is going to be the dominating effect, which is going to lower staking levels at some point, right? And finally, I just want to conclude saying, this is important for the transaction, sort of reminding you this is important for the transaction, the well functioning of the transaction activity on the blockchain, which is crucial for the functioning of any transaction volume in the DeFi protocols that are now being used, leveraging this technology to create these sort of new intermediaries. Okay, thank you very much.
Discuss this interesting paper. So first I want to give some background information about proof of stake. Okay, so we know that blockchain is basically a form of ledger, a ledger of recording transactions. For transaction to be added to the ledger, we need validators or ledger keepers in general to put the transaction onto the blockchain. And these ledger keepers, in the context of proof of stake, they receive rewards in the form of newly issued cryptocurrencies. So in the following, I would just call cryptocurrency a token, because token has only 2 syllables, right? Even crypto has 4 syllables. It will save some time. So these new tokens, right, are rewarded to the validators. And this whole mechanism is actually very important for keeping the security of the ledger. Why? Because think about it, right? If you want to be selected as the next ledger keeper, if you want to be endowed with the power of changing the blockchain, that is what the ledger keeper does, right? Adding a transaction. You need to basically stake a large value of tokens. And if you want to get selected by more than 50%, you want to stake probably more than 50% of the total stake value. And this is very expensive. And that's how proof of stake can help to maintain the security of the ledger, right? But there's always another equilibrium if we think about it. We can have a total different fixed point, right? Starting with a very low, very cheap token price. Even the total market value of tokens is very low, and it's very cheap to gather more than 50% or even a higher percentage of the total token market cap, and you can stake it. And then you have a very high chance to modify the blockchain ledger at your will. You will be selected with a very high probability to be the next validator, right? So the ledger is not secure. If I want to, if I'm a malicious player, I want to change the ledger to my advantage. Probably the first thing I want to do is to become selected as the next validator and then write one transaction, seeing the following: everybody sending me their tokens. And then I basically get all the tokens. So there's always this issue of equilibrium multiplicity. But this is true for anything related to monetary economics, I guess. So we shouldn't be too harsh about crypto. I think I have already covered the first slide, except the research question in this paper. In this paper, what we want to understand is this question: does increasing staking rewards actually increase the staking value? Because it is the large staking value that is protecting the ledger against the malicious users, against the people who want to take over the ledger and change the ledger to whatever they want, right? So we want a high staking value. But does increasing staking reward really achieve that? Well, from an economics point of view, the answer is obviously no, because token price is endogenous. Issuing more tokens to reward the staking, increase the token supply, this can change the token price, right? But this question, this conventional wisdom is conventional in the context of blockchain designers, in the context of computer science people. They typically take token price as some positive value that is exogenously given, right? And then let's design some protocols surrounding that, ignoring the fact that there can be multiple equilibrium, and also token price is actually endogenous to a design. But then let's put our economics hat back on. In this paper, the authors actually show a more concrete mechanism where increasing staking reward can actually decrease rather than increase the staking value. So what is the mechanism? The mechanism is the following. So first, we need to understand that raising the staking reward constitutes a transfer of wealth from the short-term to long-term token holders. So to understand this intuition, let's fix the total value of tokens, right? The total value of tokens that have already been issued and that will be issued in the future through rewarding the validators. So now, if you increase staking reward even more, what you are basically doing is that you are changing the term structure of token supply, right? You are tilting it more towards the future. So this basically helps the people who can stake the token for longer, because every investor's share in the total value of tokens is basically, your current holdings and the staking period, the tokens you will receive in the future as a form of staking. So once we understand that increasing staking reward is a wealth transfer from short to long-term holders, then we can try to understand why increasing stake rewards can actually decrease the equilibrium level of staking value. So first, there is this intensive margin, right? Let's, again, fix the total value of tokens. And then now let's think about this wealth transfer. Certainly, it will make the long-term investors happier, and it will make the short-term investors less happy. And this you may think, well, this is good for the long-term investors. Maybe they want to stake more, and this is overall a good thing. This may increase the equilibrium level of staking value. But there's also the extensive margin. That is what determines the total value of all the tokens. It's given by the total amount of dollar wealth invested in tokens, right? So if you really hurt the short-term investors a lot, they will invest less. And the reduction of short-term investors' investment may overwhelm the increase of long-term investors' investment because they get a larger share. And as a result, we may have the overall dollar value of all the tokens decline. This will drive down the long-term investors' payoff through token rewards, and this will decrease the equilibrium level of staking value. So we may have a left curve. I have 3 comments. I have only 3 minutes left. 5 minutes would be enough. Fix all these technical issues at the beginning. All right, so it's actually part of my fault because after I sent the email, I never received the email reply. I should have followed up. Yeah. Okay, so my first comment is that think about what is staking. This is literally what I copied from the paper. A cryptocurrency unit is said to be staked if its holder